In this video, we continue our discussion on Chapter 16, in which we go over labor demand, where in our last video we revisited the consumer problem in order to develop labor supply. Now we seek to revisit the firm problem in order to develop labor demand, in which we'll do so by setting up some preliminaries to recall our firm problem and conclude with labor demand. Where, overall currently, we are seeking to examine labor markets in order to see how wages and labor hours are determined, where this requires us to develop our twin forces of labor supply and labor demand, where thus far we have revisited the consumer problem in order to develop labor supply. Now we seek to look at our second component of labor demand, in which we need to revisit our firm problem first. That will then allow us to put the two together to see how wages and labor hours are determined in our labor markets. So with that in mind, let us now recall our setup for firms. Recall that firms want to make themselves the best off possible given how well they transform resources into goods, where they will supply goods and services and demand factors of production, where for a majority of the course, we focused our attention on terms of how they supply goods and services in the form of product supply. Now we seek to see how they demand factors of production, more precisely currently labor, and that will give us labor demand. And in terms of the setup for firms, recall that formally that we could state this as the firm problem in which they seek to maximize profits subject to the production constraint. Where, additionally, recall that in our discussions of the theory of the firm and our overview of market structures, we examined the firm problem in order to explain how firms transform their resources of capital and labor into goods and services, where we overall saw that the marginal cost curve to the firm corresponded to product supply, where product supply is only one result from the firm problem when we go through the profit maximization process, where in addition to considering at what rates a firm will supply their goods and services, we can also consider at what rates they will use their factors of production such as labor, where given that in the production process, factors of production are used in order to make a good or service, where factors of production are our input and our result or our output will be the goods or services, where in regards to our output in terms of our goods and services and our studying of product supply, we looked at how additional costs from producing an additional unit of a good or service would cost, where with our factors of production, we will be concerned with additional revenue from using an additional unit of a factor of production, such as labor, where this will overall generate factor demand, or in our current case, labor demand, which we'll define as the quantities of labor employers are willing and able to hire at alternative wage rates in a given time period, holding all else equal, where examining additional value added and additional labor will require us to revisit two concepts that we've seen in the past. The first concept being the marginal physical product, that is, the added output a new hire can produce, or the slope of the production function, that is, a one unit change in labor corresponding to a particular change in output. Our second concept will be marginal revenue, the value to the firm that an additional worker brings, which will be the slope of the revenue function, or a one unit change in output corresponding to a particular change in revenue. Revisiting these concepts graphically, let us start with the marginal physical product. Since it's the slope of the production function, let us first graphically look at the production function, which we'll have on the right. On the vertical axis we have output, and on the horizontal axis we have quantity of labor. Here we have a short-run production function in which this firm has a fixed amount of capital and a variable amount of labor, where in terms of our production function, we know it has the property of more is better in terms of as more labor is used, more output can be produced. It also has the property that each additional unit of labor brings about a positive amount of output, but not as much as the prior unit, or diminishing marginal returns on labor. So this gives us overall that our production function is increasing at a decreasing rate, where this property of diminishing marginal returns corresponds to a downward sloping marginal physical product curve that we see here in blue, in that each additional unit of labor that's brought upon from points B to point G give a positive amount of output that they can produce, but they are not as productive as their prior unit. Now let us graphically recall our second concept, that is marginal revenue, where first we will assume that we are working in a perfectly competitive market structure such that our individual firm is a price taker, such that they take the price that is given in equilibrium in the market as given. Therefore, when we look at the revenue function, it's going to be price times quantity, where the rate of change is solely going to be price. And this gives us a constant marginal revenue curve, which we see on the right, where price is on the vertical axis, quantity is on the horizontal axis, where here we have the price point that is found in equilibrium for this particular product market, and this corresponds to our marginal revenue, or the rate of change for this firm's revenue structure. Now, with our rate of change in terms of our production function and our revenue structure considered, let us now see how we can examine the two together, and this will form the marginal revenue product, or the dollar value of a worker's contribution to the firm's output. The marginal revenue product we can look at by scaling the marginal physical product by marginal revenue, where this will give us the marginal physical product scaled by price, where price is given and is a constant, and our marginal physical product is downward sloping. Additionally, we can also look at this in terms of our slope form, in which our marginal revenue product is going to be our marginal physical product, the change in output divided by the change in labor, scaled by our marginal revenue, which is going to be our change in revenue divided by our change in output. We see that change in output is on the numerator on our marginal physical product, and it's on our denominator in terms of our marginal revenue. These two terms can cancel out, and so in terms of slope form, this gives us that we have a change in revenue divided by a change in labor, or a 1 unit change in labor corresponds to a particular change in revenue, where this overall generates the labor demand for a firm, in that there's an inverse relationship between wage and labor hours demanded, given that the marginal physical product is downward sloping due to diminishing marginal returns on labor, and our marginal revenue is equal to the price of the good or service, where the firm is a price taker, therefore it's constant. So as the marginal physical product increases, it decreases the marginal revenue product due to each additional worker being brought upon on board not being as productive as the last unit. Therefore, the value added to the firm is declining, and this value added sets the maximum amount that a firm is willing to hire for the worker at a particular wage rate. Or graphically, what this means is on the vertical axis we have the wage rate, and on the horizontal axis we have the quantity of labor. We have a downward sloping labor demand curve as expected, and that there's an inverse relationship between quantity of labor and wages, where our downward sloping curve is our marginal physical product, and our wage rate is the corresponding value added that each labor unit is bringing to the firm, and that it's the maximum amount that the firm is willing to pay for a particular unit of labor.